Hello, everybody. Welcome back. Welcome to TWB's Fed Watch. What are we calling this? Got some fun name for this? Watch Jerry Sweat. Is that what we're going to call this? I don't know. I think I put a tweet out or something along those lines here. Thank you very much, Chris, for being just such an awesome assistant here helping me. But anyway, there you are. Getting ready for the Fred. We're watching the markets as JB begins his thing. So, I don't know whether, I guess this thing pauses when I first load it up. Yeah, there we go. So are you ticking away? Yes, you are ticking away. Good. All right. So Fed's basically pause on rate cuts. What a surprise. I don't think anybody really was surprised by that. I suppose the big thing is what's who going to do in response and make this guy's life as difficult as possible over the next 4 or 5 months. Interesting to see Bank of China here also left rates unchanged. U.S. dollar is getting absolutely taken to the woodshed here recently. So it is interesting to see on that event. Maybe the market was anticipating that the Fed would fold like a cheap hooker who was punched in the stomach by a fat man with spots on his face. Who can tell me who said that? My 1990s reference. Anyway. So U.S. dollar catching a bit of a bid here. Probably going to see a bit of a pullback here in all of these currencies here over the next few days, just simply because that was such a violent move down on the U.S. dollar index. I suppose you could argue there is a certain amount of position squaring going on following the Japanese. Their bond market has really come apart. I get the impression, I think if I'm not mistaken, there is an election in Japan coming up here in February. So that's a pretty big political event there. And we'll probably have some pretty big ramifications. Interesting, the fact that the Fed left rates higher probably is intimating to the bond market, sort of hinting to them that they still think inflation is a problem. And then if we have the overhanging unwinding of the carry trade out of Japan, and their bond market is absolutely collapsing. Rates are, I wouldn't say skyrocketing, but relatively speaking, Japanese interest rates have gone up quite a bit recently. Is that going to weigh on these Western civilization bond markets? I will say, this is a very big astrological event window here. Tons of transitions. We are living through historic times here. I wouldn't take this for granted. If anything, I think we're probably all students of the market through this. None of us have lived through these great resets before. Last one was in the 1940s, and most of the people who were adults then have long passed. So it's 2026. If you listen to Olga, I don't know whether you ever listened to Olga Morales. She's a cutie out of Australia. This is 2026. Can be one hell of a year. So, I mean, if it isn't already, your crazy gold price going straight up here. Actually, interesting to see the gold price actually calming down here a little bit. And I think one of the reasons why is because energy, it looks like it's trying to bottom here in earnest. And of course, the seasonal trade, buy your unleaded the middle of February, sell at the middle of May, money 9 out of the past 10 years. And I also think that our inflation deflation gauges and the bond market itself is starting to see that turn in energy. why the people that are in charge of our society don't talk more about the fact that energy is the ultimate leading indicator for inflation, and inflation worries start to come to a head when energy prices start trending higher. So I wouldn't even be surprised if there's even some sort of shock out of the energy market this year. But there could be shocks from like 10 different directions. That's what's really interesting about this current market. If I understand correctly, I think there's a coup going on in China right now. I think it was I don't know what the term is, put down. I don't know whether that's the right way. I'm hearing generals are dropping like flies over there. So you could have China just dissolve into chaos. And I've been talking to you all along that I don't believe this. China is the second world largest economy. I actually think it's all a big fraud. And they're just simply living off of the money that they've collected in trade surpluses for, basically marketing their slave labor to the world economy over the past 20 years as a great way to keep inflation in check for the Western societies. And soccer mom goes to Walmart, sees the price of whatevers are cheap, and they don't say anything. So I got the funny feeling that those days may be coming to an end, if they haven't already. And we should be all watching Japan here. What happens through that February election? As I said, their bond market is really moving. And their currency is starting to act interestingly. I don't think it's trending higher yet. But I definitely think we want to keep an eye on this. It was interesting. I think somebody had asked me when we went through this rally, whether this was the start of a new trend, et cetera. And I was like, well, V bottom, let's see what happens over time. So same sort of thing, pretty violent move off of the lows. Their bond market is moving precipitously. I don't happen to have Japanese bonds on here. I don't know whether that's really a sustainable move over time, or whether maybe we're just carving out like a megaphone here. We'll sort of roll over. Interesting. Stop loss order was just, I was doing a tutorial on us considering taking a trade on BMNR. Anyway. All right. So enough of the pre-ramble. Shut the hell up, Beamish. Let's listen to Jerry. And what I would strongly suggest is watch how these bonds act through this conversation.
I remain squarely focused on achieving our
right. I've got the screen on. Do you have
goals of maximum employment and stable prices for the benefit of the American people.
Did you send me the link to Jerry? There he is
talking. At a solid pace last year.
I'm going to put myself on mute. If you could send me that link, Chris,
on a firm footing.
What he said.
While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really 2 questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose.
Ooh, bonds are
recent months.
flying.
So we saw, data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas, but I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? If so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the U.S. currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week?
Good question.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But, what's your view on the market movements? What do you think behind them? Is it asset managers
Oh,
diversifying?
dodge.
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the Beige Book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Ain't no rate cuts coming now.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you.
This is just gonna piss Taco off so bad.
You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the
Did
longer
notice
run,
their
of the
MM
S&P, the longer
magic.
run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. And maybe I missed by one, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. You know, it's in the eye of the beholder, and of course, no one knows with any precision. Is that, you had a follow up?
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, the Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira. Thank you, Chair Powell. Amira Mokway from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So
the only guy who said Mr. Chairman.
Estimates,
everybody else is Chair Powell. We love you.
Most of the
Fox News. Oh, we're a puppet of Taco. We hate you.
From tariffs, and that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, ex the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices peaking and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted, and I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the
that's
New York Times. Can you talk more about what you would need to see
I still
in
think
the
the
labor
hegemony
market
is in
to
control
conclude it's
here.
time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, ultimately we'll do we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot, really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from our moving our policy around, but it's much more assessments
Those
of the
rates
fiscal
seem to like
path
what they're
and
hearing
fiscal
today.
policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to
protect the
this
Rothschilds.
common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So I'm not talking about the U.S. context. This is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, first of all, it will be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I'm strongly committed to that, and so are my colleagues.
Archie.
Well, the market will like to hear that.
Archie Hall from The Economist. On that sort of stabilization of the labour market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment.
Greenback's taking it on the chin here.
Do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, or strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions, and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially, the economy has once again surprised us with its strength, not for the first time. Consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from, but. The economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven.
Bonds are going
The president
parabolic.
calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart.
4-hour
because,
gravestone doji
our
just
job is-
printed on
our
the
job
U.S.
is price
dollar
stability.
index.
And so,
Kaboom.
the best thing we can do for people who are feeling that squeeze is to keep inflation under control and, frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being a positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So
Look at
everyone, of
those
course, is
bonds
watching
go.
AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time is rising productivity. So we always ask, well, this is going to be different. Is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Becky.
Thank you, Chair Powell. Beyi from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, no one thinks they will, ex ante understand really clearly precisely when this will happen, but there's an expectation that sometime
Big level on the currencies
in the
here.
middle quarters of the year we'll see
big level on the currencies here.
Tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period, and you can see for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether things are moving in that direction. I think we'll be able to see.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement.
He's gonna
or anything like
dodge.
that. Geopolitical risk for us is a lot of it is around.
Way to go,
energy,
noob.
oil.
Ask a noob question,
And
get
so
a
far we
noob
haven't-
answer.
For all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, the economy, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but it would depend. It depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output. And it would matter over time. The numbers you cite were for quarters, and quarterly GDP is, you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year. So the overall, over the year, the numbers were nothing like that. It was more in the mid-2s for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So there has been, you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, the labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any.
Whoa, U.S. dollar just dodged a bullet there.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is
don't eat tacos.
Stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Well, another is that our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, It's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant
Someone
price
was
increases
asking
we've
about
seen
the
for
gold price
precious
commentary.
metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
Hi, Nicole Goodkind-Barron's. Some
Look at the little
prominent
double top
critics
there
have
in
charged
gold.
that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections, and that's the basis for how we think about the economy. So, and the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model, and we knew it from the very beginning. It was not in the model. A trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here and like maybe happening now with AI, we're all over that. And, everyone studies those periods, and, we're very clear-eyed about the possibility that this higher productivity may persist, and also that it may not. We're not, no one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time.
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place. You can pretty much track its effects on pricing and on everything, and so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data. And our forecasts were not far off. What changed was, as I think I said earlier, what changed was what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
And he's done. Wow, he seems like he was in quite a bit better mood than recent meetings, eh? So I suppose now we can do a quick review. What did I see happen here through that? I think the most important development was the very noticeable shooting star on the US dollar index through that. So on the announcement that they weren't going to lower rates, US dollar is catching one heck of a bid. And as he talked more and more, the message that I heard was actually, things aren't that bad. Economy seems to be doing pretty good. Inflation's still probably about 50% higher than what they'd like. But, if we had our druthers, probably just stay here. Keep in mind, and I don't think a lot of you are aware of this, but when I first got into the business, the rule and when you talk in the brokerage business, you're talking mostly cliches. And the rule, the cliche was always, you want a guarantee? I'll show you 3%, i.e., that's what the central crooksters are going to pay you to hold their paper. So with Fed funds sitting here 3.5, 3 3/4, somewhere in that neighborhood, we're not that far away from actually what is historically normal, neutral, right? I could see, you make the argument that, they're slightly restrictive with that 0.5% above 3, but not appreciably far away from that historical norm. So, and frankly speaking, I think he's actually sitting in a pretty comfortable position, other than, of course, he's got this guy who seems to, there's no point in making any comments about Mr. Taco. We all know about his wonderfulness. I did find it interesting that a lot of the reporters, and I think you can actually gauge the sentiment of the market based on that room of reporters, because those are the people that go out and talk to all the, like if you think about like your nightly news broadcast, there's the pretty lady anchor with the big hair, and there's the handsome gentleman, right, who has the deep voice, and Ray Burgundy guy, right, that kind of talk. There's the sports guy, and he lives his life off in Sportsland. And there's the weatherman, right? And he's doing the weather and talking about that. And then, of course, you've got, Bart's people. You've got the roving reporters out in the field. And then, of course, you've got your financial reporter person who talks a little bit about what happened on Wall Street today. So that room of people that were interviewing him are those, these are our Channel 6 News financial market specialist reporting in what happened at the Fed today. So think of that room as like that's the public sort of input into this. I sure like that Yahoo lady, eh? I love the Yahoo lady. She's so smart and sharp. I love her. And I love that British lady. Oh my God, she's awesome. Man, those two are cool. Always like Steve Leisman. I've been watching him for 30, 40 years now. Back when he actually did have hair. And then, of course, you've got the noob coming in from, I don't know, CBS News or whatever. Hey, sir, what do you think about these international politicians talking about you? Shut up. Who let this guy in here? You can totally tell that was the noob, right? And he just got schooled. I thought that was hilarious. I even chimed in there. I mean, you ask a noob question, you get a noob answer. So I did see, though, that somebody here in the comments had said that, geez, this looks like the market is screaming, cut rates, cut rates, cut rates. And I actually disagree with that completely. I don't know whether you're aware or not, maybe you're not, but a falling US dollar index is actually extremely bullish for growth. So I might make the argument that, of course, we've got all this kind of fun back and forth. I think probably a better way to look at this, I actually think, based on January barometer kind of commentary, that I think that this market actually wants to move quite a bit higher. And based on what the conversation, of course, got to find the darn charts. Based on the conversations that I heard grow, grow, grow. Let's all grow. So if we have a falling US dollar, that's actually extremely bullish of growth. This is the chart I was looking for. It's been my assumption since we entered in this insane world that we live in, especially with all of the woke influences that make absolutely no economic sense whatsoever. And it's just the opportunity for this, minority of society to speak up and have their voices heard as we sort of make this generational transition. The baby boomers are just too old. And frankly, they're living their lives of, senior citizens' lives, golf courses, eating dinner at 3:00 in the afternoon, that kind of thing. And the millennials are too young to have any serious significance in our society. So we have this funny air pocket. And unfortunately, I think that this happens once a century. And of course, the one percenters, put on your tinfoil hat, cabals, all that, they take advantage of this window to pull off their great resetting. And in essence, the millennials are now inheriting what their new world for the rest of their working lives is going to look like. And of course, if we are talking, money and markets, then of course we have to pay attention to whatever the hell the world's hegemony is. I don't, and it was interesting, did you hear him say when somebody asked, oh, well, we're getting reports that international money managers are aggressively getting out of the US dollar. And he was like, no, I don't hear any of that. And I have been acutely trying to perceive whether this is fluffy public idiocy, because the public always does the wrong thing at the wrong time. Everybody and their brother, of course, is a gold and silver bull right now, but buying gold and silver here is just asking for trouble. That's like buying Bitcoin, well over 100 grand. Bitcoin's still, 80, 90 G's or whatever. But it's certainly not 120, 130. I wouldn't be surprised if gold actually is trying to figure out some sort of new trading range, and it's trying to figure out whatever the heck the new top of this range is. And it was interesting when we were talking gold the other day. I can't remember. I think it was on a Sunday broadcast I did that. Where the gold price peaked the last major inflation cycle there back in the early 1980s. And one of the crisis windows, the gold peaked at like $517. And I believed at that point that the market was oscillating around 500. And actually it slipped back below 500, then came back to 500 and change later on, etc. So I kind of think that we're probably establishing some sort of upside trading range, sort of ceiling on the gold and silver and the metals markets. And in a weird sort of way, I have been waiting patiently. Like, I mean, this is like 5 years of your life waiting for this harmonic pattern to finally complete itself. And the interesting thing is that the 78.6 that I've been barking about forever here on this US dollar index is sitting right now at 95 and change here, right? I think that's the number. No, 93, beg your pardon. 93.82. So yes, the currency is coming off here in the past couple of weeks. It's been dramatic. But in a weird sort of way, does this not sort of seem like, you heard the reporter in there, oh my God, have you seen the US dollar collapsing lately? And ironically enough, Jerry goes, it's not my problem. That's Treasury. So, clearly Taco and the people, of course, that he's, Basant and all that crap. They are the ones that are causing this. And of course, you look around the world, tacos aren't making too many friends. So it doesn't really surprise me that it wouldn't even surprise me if after the fact we actually find out that this was actually generated by the Trump administration. And really didn't have anything to do with interest rate policy or the U.S. economy. If I understand correctly, the U.S. economy is actually outperforming in the world right now. One thing I did notice, and I think a lot of this actually has to do with that Japanese carry trade. And you heard one of the reporters make a comment about the Japanese situation right now. So this might even be external to what's actually going on domestically within the US. This might actually have everything to do with Japan and nothing to do with the US, which is interesting because, the sentiment right now, if you look at the gold market, oh, it's the end of the world. And the sentiment on the currency, you hear people, oh my God, the US dollar is crashing. But that's the way people talk at the end of moves, not the beginning of moves. So I, for one, still believe that we've got a date with this 93 and change down here, which means that this thing's going to fall another 4 or 5% here. I'm not debating that here in the near term. This is a damn ugly looking price action. But I do feel as though this is heading into some sort of apex. What's interesting too, of course, if we look over at the January barometer, and the S&P 500, which is basically a U.S. stock market, this is pretty much what I'm expecting 2026 to look like. It is going to be one crazy-ass wild ride. And in fact, I might even argue that this is now painting a megaphone, which is more volatility, not less. And of course, given the political situation, that makes perfect sense. It is interesting how this 3-bar fractal did actually fire here. Remember in the meeting, I had pointed out that, oh boy, the US dollar index itself came really close to firing a actual candle signal. This 4-hour shooting star, aka Gravestone Doji, and it looks like it's tipping over again. If we go through this low, then really our target should be in the near term here. But this does start painting fractal failure and further move down. And, my earlier comment that the US dollar index actually trending lower is actually very bullish for growth. The problem here, though, is it's actually very bullish for inflation, too. And I think one of the reasons why you're seeing things like the gold and the oil and, interesting stocks aren't really moving that much here, but you saw the S&P 500 stocks were already right up at the top end of their range. But especially in the commodity space, you see everything is moving up here in unison. That in itself is a bit of a problem because gold is the lagging indicator in inflation and energy is the leading indicator in inflation. So one of these two is wrong. My hunch is that oil prices are getting ready for their very normal seasonal bottom through the beginning of February. And I think energy prices are going to go up dramatically here this year, but we'll see. And if that's the case, then gold prices should probably calm down. I don't know whether they crash. I doubt it. But they're probably going to be looking for some sort of cycle peak, maybe over the next 6-8 months kind of idea. Also, too, if we think about some bigger macro data that the market is telling us right now, the question is, do you want to listen to it? If we look at things like the gold silver ratio, this is actually implying an extremely strong economy. Regardless of your tinfoil hats, cabals, all that kind of crap, there's some crazy ass stuff going on in China right now. Technically, there's a civil war going on there, although the bullets haven't really started flying, but generals are dropping like flies right now over there. So there might be a severe lack of confidence in the Chinese Fugazi. Frankly speaking, I think the whole thing is just a total paper tiger. And that might be a big reason why you're seeing just this massive flight into the metals right now, is people are actually outright scared that China could dissolve into some sort of absolute chaos right now. So regardless of your, conspiracy talk, silver is considered an industrial metal. Hell, it even goes into some clothing, right, to try and remove the stink. I could use more silver in my life, I suppose. Those Lululemon yoga pants, though, they're going to get damn expensive, eh? Anyway, whereas gold is the system's broken, US dollar sucks, no confidence in the Fed, and we're going to go bury our head in the sand and just buy a lump of gold and sit on it in our mattress and screw you, capitalism. So this image right here is an extremely bullish reading on the economy. And do your own due diligence. What was the economy like in 23, 24? That's when, of course, all the inflation problem was, it hit ahead here. But the economy did relatively well. How is the economy right after? Of course, I'll sacrifice my life to save capitalism, right? Now the economy just went crazy. And you'd be surprised when you do these funny little studies in this funny little sine wave study, when this hits an apex, we hit crisis. And that's the buy your gold, bury your head in the sand, get the out of the economy, things are bad. That is not a things are bad image. So, take it for whatever it's worth. I think the market is screaming at us that get ready. And, again, going back to our January barometer, oh, by the way, the stock market hit a new all-time high here today. Stocks are the ultimate leading indicator. If stocks hit a new all-time high, that's not a weak economy. But unfortunately, with this nutso politician, and I don't know, everybody's got an opinion on this guy. He has a nasty habit of throwing wrenches in the works every once in a while just to piss everybody off, I guess. And actually, you even heard Trump. This is not Trump, JP. He even made direct reference to this when he said, well, we had our people analyze the data, and we've got some pretty smart people here. This is actually something that Taco does a lot, is that he comes out and he makes the absolute absurdist, over-the-top statements. And then when you actually look at the actual deal that he carves out, it's a fraction of how bad he starts off the conversation. And I think this is his basic, this is the way he's done business his whole life, is freak the other guy out on the other side of the negotiation table. Just do or say whatever you have to do that's literally going to get them to poo their pants. And then walk back and you come to some sort of middle ground deal where he feels as though he got what he wanted originally. So, and frankly speaking, this, for us to sit here and actually predict what's going to happen in the future, good luck. None of us can do that. But I can certainly tell you, from my perspective, the first half of this year, sell in May and walk away kind of idea, you should prepare yourself for a dramatic move higher in prices. Now, it might be all of the prices all move up in unison, housing, your loaf of bread, your eggs, your stocks, everything. It might just be stocks. And maybe the comment that you heard out of Jerry is that the tariffs are a one-time injection. I wouldn't even be surprised if Taco comes out and says, all right, now it's time for round 2 of the tariffs, and we start the whole crap all over again, freaking the world out. Wouldn't surprise me. You know, that's the way this guy operates. But I would definitely say the first half of this year, I am going to be looking for higher prices. I think that there will be a typical seasonal peak, and I do think that there is going to be some serious shock about the middle of the summer. You know, this tinfoil hats, is it politics? Is it the Rothschild type people? You heard me make reference to Jerry and, you know, the independence, quote unquote, of the central banks. Yeah, right, sure. I don't know what the hell the shock is. I can tell you that Jerry and the Rothschilds and that crazy ass nut job that's running my country right now, they want to get rid of Mr. Trump, and more importantly, they want to dilute his power base so they can't, so he can't keep destroying their beautiful, wonderful globalization business model. Is that people walking up and down the freeways, lighting literally the forest around the freeways on fire. And we watched that in 2020 when the last major political event through the whole sickness, them just, you know, and it made no sense why this stuff was happening, and nobody followed up on it following the event. And it was that just further sort of adding fuel to the fire of the anxiety of the population and get them to vote change at all costs kind of thing? Maybe. Or it might be that Winnie the Pooh finds a bullet between his ears. You don't know. But I will say that the market is warning us something is coming the middle of the summer. Now, the interesting thing, and this is what I find fascinating, is that the reaction following that event was actually pretty darn violent and very bullish, so much so that it took us to new highs. And this is just about election day. So my hunch here is that there's going to be some sort of derailing, but I think there's going to be kind of like a rally around the flag kind of idea. And then into the actual election event, actually, I think it's going to be a euphoric event. And then it's kind of like buy the rumor and now sell the news. I don't know. We'll see. So I'm still watching the January barometer as it plays out here into month end. But if it's one thing that the market is absolutely telling us, in my humble opinion, is that the first half of the year should be a pretty darn, lucrative for those that are long. And you even heard Jerry say things, households that own stocks, households that own real estate, they're feeling pretty good. And I don't see any reason why that should change. And unfortunately, I think this is just a reiteration of the K-shaped economy, that those people living on the margins, life is still going to be very difficult as this forced inflation, great resetting, whatever you want to call it, that literally has to happen in these democratically elected governments sort of cycles to keep being able to make promises to the public that really you can't make nothing out of nothing, or you can't make something out of nothing. So everybody in Western civilization that has bought into this socialist dream, what you've really bought into is this great resetting model. So once every 100 years, when the predominant demographic ages out and they can't say anything, and the new demographic is caught in this little window where they're not old enough to really have any political power, that's when these people do this to us. They did it in the 20th century, they did it in the 19th century, they did it in the 18th century. You can go back century after century after century, and it's actually pretty darn consistent. It's almost disgusting how consistent it is. So there's your market. It was enjoyable. A couple things that I took out of that presentation, me just personally, is that sure looks like Jerry's a hell of a lot happier. I think that the consensus around his boardroom table was indeed to leave rates alone. But I also think to a certain degree that those people around the table basically looked at him over the past couple of weeks and said, don't worry, Jerry, we got your back. And I don't think he gives a rat's ass about what Taco thinks or feels. And, Taco will just turn around and go, well, it's politics, same old rhetoric. But Taco's going to try absolutely as hard as he can to try and, of course, intimidate, bully anybody he can. That's the type of guy he is. So if anything, to expect anything other than that from him would actually be abnormal. It's impossible for that guy to be nice. So, there's your market. If anything, I got to be kind of proud of Jerry for being able to stand on his own 2 feet and just basically thumb his nose at Taco, because at the end of the day, I don't think he really has any problems. He even said, and I agree with him 100%, the authority that's vested to him doesn't come through the President of the United States. It comes through the U.S. Congress. And if anything, if people really want change in the United States, they need to look at their Congress and their legislature as the tool for change. So theoretically, the President of the United States is supposed to be nothing more than just the ultimate lobbyist of the people. He doesn't actually make any laws. So how ironic how the past year has gone. All right. Anyway, I hope you enjoyed that. I got to head off to another tutorial here in 45 minutes. So have yourselves a great day. Hope you enjoyed the frivolity. Lots of fun. As you can see from this projection, it's going to be one hell of a wild year. So strap on your seatbelts. It's going to be a lot of fun. All right. All the best. And bye for now.